Hi there, welcome back to Closing Trades. Last half an hour or so of trade, let's talk about some sectors that are not doing well. It's the entire PSU bank, banking, financial services space that's pretty subdued in today's trading session. In fact, they're almost the top losing sectors also of today's trade. But two stocks from the entire financial services banking pack are in focus today on the back of a negative Goldman Sachs note coming in, and that's IndusInd Bank and SBI Card. First, let's talk about IndusInd Bank because Goldman Sachs has initiated a downgrade for both of these stocks and also for IndusInd Bank, wherein they have maintained, or in fact they've downgraded the stock to a sell rating and cut the target price as well for SBI Card, but for Goldman Sachs, for IndusInd Bank, pardon me, they've hiked the target price to 722 from 634. But their reasoning for the cut is that they believe that the bank is likely to have weaker growth profile going ahead. They've cut the EPS by 25% and 17% for FY26 and FY27, and they believe that this cut is driven by the loss of market share in the bank's key loan portfolios and deposits. They believe that the revenue engines of the bank are slowing down and operational controls, they continue to remain challenging. So that's the take coming in from Goldman Sachs on IndusInd Bank. But even for SBI Card, they have downgraded the stock to a neutral rating. Target has been maintained at 1006 rupees per share. They've cut the EPS by 9.5% and 7.8% for FY26 and FY27 as well. Both of these stocks are under pressure. Anywhere between 2 and 3% of cut is what we're seeing on both of these stocks. But let's also welcome on board our guests who are joining us now. We have Nilesh Jain, who's joining us from Centrum Broking, and we also have Nagraj Shetty, who's joining us from HDFC Securities. Welcome to the show, both of you, and wishing you a very good afternoon. Nilesh, let's come to you. Give us a sense of what you are making on these two stocks, IndusInd Bank and SBI Card, and what are your views when it comes to both of these stocks on the charts, because these stocks are quite under pressure today.
Very good afternoon everyone. Absolutely. So today, in fact, I would like to start with SBI Card because the stock has given a structural breakdown. A rising trend line has been broken down. The stock is trading below its 50-day moving average after today's breakdown. So looking at the overall structure, looks like it is heading towards 880 to 870 on the lower side. So any pullback from here might get sold into. Till the time it doesn't reclaim 950 on the upside, the structure looks likely on a weaker side from a short-term perspective. On the other hand, IndusInd Bank, in fact, after 4 days of gain today, it has snapped its 4 days of winning streak, and looks like it is likely to find some bit of support near about 840, 835 levels. It has multiple support levels, so I don't see any major crack in this particular stock on immediate basis. There could be possibility of some bit of pullback or rebound from the lower levels. So if somebody is already holding the long position, can keep a stop loss below 830 and stay put with the long position. There could be possibility of some bit of a pullback towards 880 to 900.
All right, that's about IndusInd Bank. So let's watch out for this particular stock. But other than that, it's the metal bag that is seen to be shining bright. And Nagraj, within the metal counters, what is that you are making of, and which are your top bets right now? Because what we see is that fundamentally it's the dollar index which is seen to be hitting at a 3-year low for itself. And along with that, select base commodities are doing well. Any particular stock that is looking attractive at this point?
Yeah, I have two stocks, and one of them is Tata Steel. Whole metal pack is moving up, and Tata Steel is also moving above the hurdles. What we have seen recently is the strong upside momentum with the smaller dips recently. After that, it has showed a decisive upside breakout of the consolidation band in today's session. The overall chart pattern is looking positive for the Tata Steel. Currently trading around 165.40 odd levels. One can look to buy at this point of time. And immediate target would be around 10 rupees above 175. One can place a stop loss at 160. My another stock is from a cement side, Ambuja Cement. Ambuja Cement has been in a continuous uptrend over the last 8-10 sessions, and it has broken above the larger consolidation band somewhere around 580, 585 levels, and currently trading higher. The overall chart pattern is looking positive. The breakout was seen along with the rise in volume, as well as the RSI is also showing positive indication. So one can look to buy Ambuja Cement at this point of time, currently trading around 594. Immediate upside target would be around 630. One can place a stop loss at 575.
Okay, so that's the stocks that Nagraj is liking at the moment. But Dhananjay, coming back to you, give us your sense on everything that we've been seeing in the paint segment. This sector has suddenly seen so much news flow. On one side, you have JSW and AkzoNobel, and today you have CCI probe that's going to happen for Asian Paints. Give us a sense of who do you believe has the right to win and who is going to emerge victorious from this entire news flow that we're seeing on paints.
No, I think what the regulators decide is a matter of their jurisdiction. So I can't really prejudge what they are saying. So I think it'll be incorrect to bet on that. But I would say broadly, as far as the paid sector is concerned, I mean there has been a concern with respect to competition, which has been there, and I think that's been impacting the Asian Paint performance. I would say Berger and ExxonMobil, etc., have actually done relatively better. I think the trigger for the sector is if you have the crude prices falling, there is a possibility of a margin expansion. And the names that I just mentioned have less competition. ExxonMobil, for instance, less competition from the new player, which is Birla. So basically, that is how we are positioned on the paint sector.
All right, but Dhananjay also talked to us about the tire counters, because we just had your take on the auto space overall. But along with that, within the tire space, we have already seen the Q4 numbers were quite decent, and the managements were hopeful of a bit of a raw material basket cool off, and the lag impact when the crude was near about that $60 per barrel mark, that lag impact to impact their margins going ahead. Give us your sense on the tire counters, and also because of the correction, are you finding these bets attractive?
So I think we are more constructive on the entire auto ancillary space, and tires are included out there. I would say we are seeing kind of a lessening on volume growth as far as OEMs are concerned. So I think that is something that is sort of a drag from a volume standpoint. But I would say that there will be a reasonable amount of replacement demand, because with a lag there will be, there has been a significant rise in volume growth for passenger vehicles, for instance, especially the premium ones, and that will have a lagged impact going forward. So I would say that there are certain drag, but there is a certain legacy, which is helpful. I would say then if the crude prices fall, I would say that should be helpful from an earnings standpoint for the tire companies.
Okay, Dhananjay, I appreciate that view and appreciate you joining us on the show as well. Thank you for taking the time to speak to us at ET Now. Well, viewers, on that note, we'll slip into a very short break and we'll be right back to discuss the last 30 minutes of trade with our experts on the other side.
Welcome back to Closing Trades right here on ET Now, and let's shift gear to the auto space now, because we have all the data coming in from the June auto sales, and this time it seems to be a mixed bag across the board, because select outperformers indeed within a particular segment. Let's start with the passenger vehicle segment, wherein Maruti Suzuki as well as M&M, these were the companies which reported almost inline set of numbers, while Tata Motors yet again a disappointment trickling in. Within the two-wheeler pack, it was Eicher Motors Royal Enfield which performed very well versus the street estimates, while for Hero MotoCorp and TVS the numbers were actually in line. But when we talk about the commercial vehicle segment, like we have been flagging off, that you should not expect much, because the trend in this particular segment has been quite subdued for some time now, and exactly what we are seeing on the numbers as well. Just Ashok Leyland managed to outperform, or rather beat, the street estimates by a margin. Other than that, Tata Motors as well as Eicher Motors VECV, not great set of numbers. So kind of a mixed bag, but the commentary remains positive, especially from the likes of tractor companies. The two-wheeler companies are shaping up well. The trend is expected to continue as well. But we also spoke with our experts, so let's go across and listen into what FADA spokesperson has to say on the sales.
This would not be the year wherein we see double-digit growth. It will be more of a single-digit growth, and that's what we are witnessing. During monsoons, it's kind of subdued, and we are expecting the upcoming festival season would be good because there's plenty of rainfall above normal monsoon is there as far as prediction is concerned. So we're looking forward for the festival season. Two-wheeler definitely is one of the best performing out of the pack of all the segments. And though last month was kind of more of subdued, but we are still working on the numbers. Let's see what the numbers tell us, and only then probably we'll be able to give you much in-depth analysis as far as the segment-wise share is concerned. But yes, overall, if you see for this calendar year, two-wheelers has performed better than the rest of the pack.
Okay, that's the word coming in from Farah on the auto outlook going ahead. Let's also welcome on board Gurmeet Chadda, Managing Partner and Fund Manager at Complete Circle Consultants. Gurmeet, hi, good afternoon. Good to have you on the show. First up, before we get into sector-specific discussions, give us your broad sense on where you are seeing the market headed right now. Because so far, at least when the benchmarks were lackluster, you had the broader markets that were leading the move and giving some hope. Or on the flip side, if the broader markets were subdued, the benchmarks were doing something. Today, both of them are down and out. Give us your sense of where do you think the next hope of green in the market could emerge?
Thank you. Thank you for having me. See, a couple of things you have to see. One, I think our corporate profitability to GDP is now nearing all-time high. We are at almost 4.7%. The last time this had touched 5% was 2007-8. So corporate profitability, despite earning growth being mediocre, is now at about 4.7% to the GDP. So if you see last quarter earnings also, broader market, I mean, this I'm talking about Nifty 500, all right? So broader market was about 11% plus earning growth. So if this quarter we do slightly better, then markets could sustain these levels because, you are at 21 times forward earnings. So the market isn't cheap. So I think the earnings are extremely important. I think market is also a little bit nervous on the US trade deal and what happens before 9th of July. So that event should play out over the next few days. So that's something I think the market would look up to. And then maybe some of the sectors which have been impacted by tariffs, whether it is auto, whether it is textile, whether it is selectively pharma, and host of other sectors, I think will take more direction there. Thirdly, most importantly, I think we are seeing a bit of pickup in the rural demand. That's evident in rural two-wheeler numbers. That's evident in farm equipment and tractor numbers. That's evident in commentary you listen to some of the fertilizer companies, etc. So I think that's one good part of it. And historically, whenever monsoons have been 5 or 6% above normal, agriculture GVA is around 6%. So it's about 2% then higher than the long-term average, which is 4%, which is a good sign because we had a very soft rural economy for almost a couple of years. So now I think the rural economy is coming back. Urban, I think, is still soft, probably needs a little more boost other than the rate cuts by RBI. Maybe some GST cuts would come. So I think the second half of the year could be better, but provided, as I said, earnings play out and we don't have tariff issues. Secondly, most importantly, I think we have to reset our return expectations. And I've been saying this for a while. We will not get 25-30% returns now. And I think people have got some bit of consolidation last 6-9 months. So you have to readjust to the new normal. You can't make 25% returns when you are at 21 times earnings. So have a more balanced allocation in terms of your portfolio, include some long dated bonds, add maybe a bit of a flavor of gold, and be a little modest in terms of expectations.
So that's the take coming in on the markets, but what we see right now is a mild recovery from the day's lowest point for Nifty as well as for Nifty Bank as well. Yes, for Nifty, we have almost recovered more than 50 points as we speak right now. A bit of a sharp spike coming in over there, while for Nifty Bank, since the start of the show and now, it's almost a 200 points of recovery from those levels. So let's watch out for that, whether or not we are able to sustain and where do we shut shop. But one of the other stocks that is in focus today is RBL Bank. And Nilesh, I wanted to have your take on this one because just keeping aside the news flow out here, the fact of the matter is that from those 150, 160 odd levels, the stock has seen a fantastic run up till 260 odd levels. Bit of a retracement today. Yes, it is in the news, but what do you make of this stock on the technical front? If somebody has already participated in the rally, should they move out being a trader, or do you believe that it's still a good buy on dips stock?
So Srishti, we have seen a good momentum in last 4 consecutive months. Now this is the fifth month that has started on a positive note. If somebody has already bought it from a trading perspective, I think it's a good time, good levels to exit would be 260, 265 because the stock may face resistance near about 265 to 270. It has formed a big rounding bottom formation on the daily time frame chart where the major resistance is coming somewhere around 265 to 270 zone. So ideally one should take out the profit and wait for some meaningful decline towards 240, 235, or maybe 230 could be a good entry point. But as of now, it's an avoid. We are expecting some bit of profit taking to continue.
Okay, so that's an RBL bank. But other than that, Nilesh, share with us what's looking good for the trading session and what are some picks that you would like to recommend to our viewers?
Pick is again for the metal space. We are pretty much bullish on the metal sector from a short-term momentum perspective. So Steel Authority is something that is looking positive on the chart. We have seen a good momentum and a good breakout coming in this particular counter. It is trading well above all long-term and short-term moving averages, as well as it has given a good breakout from its long consolidation of almost 8 months. 8 to 10 months consolidation has been taken off in today's trading session. So on the upside, we are expecting further momentum to continue on the upside towards, from a short-term perspective, 141 could be the target, and from positional perspective, 145 to 150 levels can be seen. So one can keep a stop loss below 133.5, and Steel Authority is long from our side. Another counter that we are liking is Polycab. So this particular stock has been in an uptrend since quite a bit of long time. We have seen a good base formation in the zone of 4600 to 4700. So from here, we are expecting further up move to continue towards 6810. So that's the immediate target. 7000 to 7200 is something that we are expecting in the July series. So Polycap is another stock that can be bought at current level, keeping a stop loss below 6620.
All right, so that's about the top bets coming in from Nilesh. But Nagraj, just wanted to have your take on some of these gas-related counters and specifically from the likes of city gas distribution companies. What we are picking up right now is our reporter suggesting that the government is planning a mega push in the pipeline infrastructure. But along with that, we are seeing Gujarat Gas, IGL, MGL. These stocks are holding up well. Give us your sense, any stock that is looking good to you right now.
Sir, actually, MGL is looking very positive on the chart. It has been continuously moving up, healthy uptrend with a bullish pattern of higher tops and bottoms visible on the chart, and currently placed at the higher levels, placed at the breakout. Overall chart pattern is looking positive. I think the next upside would be around 1620, 1630 levels, currently trading around 1510 levels. The chart pattern is looking positive for the MGL for the near term.
Okay, so that's a take on some of these gas names. But Gurmeet, coming to you, what are you making of the entire pharma space right now? Nifty Pharma is back in the green as we speak, and we've seen some IQVIA data coming in for pharma in terms of their exports, market share. What are you making of those numbers, and what are you liking from the pharma pack in terms of subsectors or any stocks that you could talk to us about?
So if you see, I think if you break pharma into four subsets, I think the healthcare hospital part has done pretty well. Whether it is Apollo, Max, I think Narayana also got up pretty well. What I think could do well once there is more clarity is the CDMO and generics. I think the market needs clarity there. I think CDMO in general, I think is a huge opportunity. Already, if you see the likes of Divis, Laurus, some of the other names, they are already at their all-time high. And if you see the export numbers of last year versus now, I think 70% numbers have already happened in the first 5-6 months. So that tells you that, and once there is more opportunity, and once the Biosecure Act, if at all, finds light at the end of the tunnel, in US, you could see Indian companies, really gaining some market share vis-a-vis China. The last one is the branded generics bit, which is more like FMCG in Indian context, where valuations are slightly rich, but you get steady, not much cyclicality in the earnings. So we like Mankind in this space. We are tracking the likes of Ipca, Cipla, etc. In this space, look at the deal which has happened recently between between KKR and JB Chemicals. I think it's a massive acquisition. Pharma has seen some really big deals in the last 12 months. So we are pretty constructive. More importantly, if you see the correlation of pharma with Nifty, it's on a short-term basis, it's around 0.6. On a long-term basis, it's less than 0.5. So when corrections happen, and in a market like this, you got to also see, downside risk in the sector. Nifty Pharma falls less than 50%. So if, for example, if you go back to 2008, when markets fell 60%, Nifty Pharma was down 27%. In COVID, again, it fell half. In fact, it recovered the fastest what's happened. 2011, again, it fell 15% versus 20-25% broader fall in the market. So it's very important for us to look at risk-adjusted returns and low correlation also while building the portfolio. And pharma has outperformed Nifty over last 10, 15, 20 years. So it falls lesser and over a long period outperforms. So it deserves more allocation and more weight, in the portfolio.
That's an interesting point when it comes to the pharma space. Let's watch out for that. But moving on, shifting focus to an exclusive then, wherein no immediate regulatory restrictions planned by IRDAI on bank assurance model. Anurag Shah is here with more details on this one. Anurag, over to you.
So it's a relief for insurance companies, particularly life insurance companies who are dependent on bank assurance channel. The companies for which the premium is high gathered through the bank assurance channel. So as per our sources, insurance regulator IRDA is not planning any sort of restriction on bank assurance regulation. So previously there were reports that due to the mis-selling complaints, insurance regulator IRDA may come up with a capping of bank assurance premium through a particular parent bank. But as per our sources, as of now, the IRDA is not planning any restrictions or change in regulation for bank assurance norms. And as per our sources, the mis-selling complaints through bank assurance channel is also not very high. The absolute number of complaints through bank assurance channel is not much alarming. So due to all these factors, considering all these factors, IRD is not planning any sort of restrictions or change in regulation in insurance bank assurance model. And mis-selling complaints will be dealt by a regulator on the case-to-case basis, and action will be taken by regulator on case-to-case basis. No particular change in regulation IRD is planning, and government has also conveyed to regulator that bank assurance channel is an important channel to increase the penetration, especially in the rural areas. In the people of rural areas trust bank branches. So to increase the penetration, to reach the target of insurance for all by 2047, bank assurance model is an important model for the insurance distribution. So government is also of view that mis-selling complaints should be dealt, but regulator will not come up with any blanket change in regulation. Mis-selling complaints will be dealt on the case-to-case basis.
Okay, Anurag, thanks for all of those details. Before we talk about insurance in detail with Gurmeet and what he's liking from that pack, Nilesh, we understand you're in a little bit of a hurry. So before we let you go, could you share with us the levels that you're spotting for tomorrow's trading session, where we can expect the market to open tomorrow, both for Nifty and Nifty Bank?
Right, as far as Nifty is concerned, tomorrow we'll be having a weekly FN expiry. So looking at the recovery today, in last couple of minutes, looks like Nifty may open near about 25,500 levels, and the weekly expiry could be seen somewhere around 25,500 to 25,600. That can be 100-point expiry range. So some bit of positive expiry can be seen from tomorrow's point of view. Bank Nifty also, we are expecting some bit of consolidation to continue. We have already seen good run up in Bank Nifty. So 56,600 to 57,400, that's the broader range for the Bank Nifty from a very short term perspective. If it sustains below 57,000 and if it closes below 57,000, then there are high possibility of unwinding of the position from the put strikes, and it may slide further towards 56,600 to 56,500. But looking at the volatility index India Weeks, which is trading comfortably near about 12.5 levels, that is not giving any sort of indication of immediate sell-off in the market. So that basically indicates some bit of consolidation to continue. Once this consolidation gets over, we can expect another leg on the upside.
All right, so those are the levels to watch out for, as well as Nilesh just highlighted that for tomorrow, where the markets can actually open. But thank you so much, Nilesh, for taking the time out and speaking with us. But just wanted to have your take